Good evening and warm welcome to all of you to the webinar of Thrissur Management Association. Today's webinar topic, investment alternative in these uncertain times. We are fortunate to get such a eminent investment consultant having more than 30 plus years of experience in the capital market and banking, none other than our beloved past president, T.S.Anantharaman, former chairman, CSB Bank Limited. Warm welcome to you, sir. Past president of TMA, managing committee members of TMA, invited guests, students, welcome all of you to this meeting. Office bearers of TMA, Dr. V.M. Senior, Engineer Vinod Manjula, Vice President, Sijo Polo, Honorary Secretary, Manoj Kumar, Treasurer, Pradap Worki, Joint Secretary, warm welcome to this meeting. Our T.S.Anantharaman sir is the state rank holder in Bachelor of Commerce with the first class, and he qualified the Chartered Accountancy at the age of 19. He's also a member of British Institute of Management, and he started his career as a lecturer of management studies at St. Thomas College. He was founder chairman and managing director of Peninsular Capital Market Group of Companies, which is a member of various stock exchanges like NSE, BSE, MCX, and so on. He was a member of the Executive Committee of National Stock Exchange of India and Vice President of Cochin Stock Exchange. He is the director of various listed and unlisted companies. He worked in United Nations as expert with International Labour Office, Switzerland. Also, he was the head of the Department of Accountancy in Management Studies, University of Botswana. As you know, he was the past president of Chamber of Commerce, Thrissur Management Association, Investors Club, Banasri Memorial Club, Barclays Club, and so on, many organizations. He wrote 4 books in accountancy and taxation, which is used in Botswana University. He is a regular writer in capital market and economy in leading dailies, also appearing in visual media, TVs, conference, and so on. He has received various awards. I'm not going to the details of awards and all of that because we are very familiar to our T.S.Anantharaman. Only for the matter of formality, I have just mentioned some of the important milestones in his career. I am sure this session will be, and you will be enriched with a lot of information. I wish all of you a fruitful session ahead. Investment alternatives in these uncertain times. Or do you see T.S.Anantharaman sir? Thank you.
There is acute risk aversion in all segments of our society because you do not know what is in store next. First time in Indian banking history, since independence, last 75 years, a document issued by a bank, there's a Tier 1 bond. They collected 8,250 crores. Yes Bank collected on Tier 1 bond. And when Reserve Bank took over the working of the bank, they said these documents have zero value. Nothing is left in them. People who invested that much money lost everything. Similarly, Templeton Mutual Fund, they closed this 6 scheme, they sort of surrendered. It doesn't mean everyone is going to lose a lot, but the redemption that happens on a daily basis has been suspended. Now people will get back whatever is recovered by the person administering the fund now. There is no question of withdrawal. So these two events have added a lot of confusion, a lot of uncertainty into the investment world of India. Probably there's one reason why I chose such a topic for today's webinar. It's time to be extremely careful because you do not know which is going to be the next black swan event. Now, before I go into the details, one interesting development in the world of finance is that yields are coming down fast. Return that you get on investment, whether it is bank deposit, bonds, mutual funds, capital market, all these areas, wherever you have invested money, yields are coming down. It's a worldwide phenomenon, not an Indian phenomenon. Again, the world is awash in liquidity. All the central banks in the world, led by the Federal Reserve in America, as well as in European countries, Japan, every country in the world have been printing notes as if there is no tomorrow and pumping in that money into the hands of the ordinary person to avert the ill effects of COVID crisis, which has resulted sort of a lockdown of the world. So they're printing currency and distributing it into the pockets of various people. So that demand is kickstarted in the economies of the world. In India, we have been following a slightly different policy, probably due to lack of fiscal space or even monetary space. We have been concentrating in keeping the liquidity in the system going in India by a Reserve Bank playing around with the non-performing norm standards, pumping in liquidity into the market, giving more loans and facilities to large companies as well as micro, small, and medium sector. This has been the emphasis in India. I'm sure most of you realize that due to the liquidity, surplus liquidity in the market, there is $15 trillion in the world bond markets, which is quoting at negative interest rates, which means if you invest $1,000 in the bond, at the end of the maturity period, maybe after 1 year, 2 years, you will get less than what you invested. That is the level of liquidity available in the world markets. The American 10-year bond rate is at the all-time low, 0.6%. That is the yield in America in the bond markets, 10-year yield. In Germany, Japan, France, many of these so-called developed countries, yield is negative. It is in this background that we are discussing the various investment alternatives in India. Luckily, in our country, the yields are still very much positive. Let us go into some of those specific items in the next few minutes. I'm given about 30-35 minutes. Let me quickly go through. I prefer to discuss this under 5 items. One is cash and liquid funds. The other is bonds, then gold, real estate, and of course, the share market. So there is no time to go into the details of each and every one, and I'm sure most of you are familiar with the fundamentals of investment, which is safety of capital, the returns that you get from the investments, the liquidity of the investments, the taxation aspect. These are all the key aspects when you make an investment. I'm not going to go into the details of each and every one. I'll quickly go through the highlights, and if anybody wants to go more details, I'm always available at the Q&A session if you want it. First, cash and then liquid investments. Here the main area is the mutual funds, liquid schemes run by most of the mutual funds. It's called under different names like overnight fund, liquid fund, money market fund, credit risk fund. There's so many of these names, options available, whether it is an overnight fund just for one night or for 1 week, 1 month, 3 months, up to 1 year, like that, depending upon your flexibility. You can choose one or the other of these funds offered by mutual fund, and the yields vary. For an overnight fund, you get something close to the repo rate, which is around 3 to 4% these days. That's all what you get. But in a fund which you can encash with 1 day's notice, but normally intended to be for 1 week, 1 month, up to 3 months, the yields are generally in the range of 5 to 6%. These are normally withdrawable in 1 day's notice. You give notice today, you get the money tomorrow. So this is the return that you get in what we call illiquid. But from an individual point of view, you don't have to go to the liquid fund. You can invest in your savings bank account, in your banks. And there are banks now in India, for example, IDFC First Bank, one of the major banks, they are offering up to 7% on your savings bank account. Even Kotak Bank used to advertise that they will give you 6% on your savings bank. Normal return is 3.5, 2.5, 4%, between 2.5 to 4%. There are specific instances. They give such higher interest to attract more accounts for a particular period. After that, they withdraw. So in an SB account, you normally get 3.5 to 4%. In a liquid fund, with a good mutual fund, you get about 5, 6.5%. This is the type of return that you normally get in these things. Next, I'll prefer to go into the bond. Bond is the place I want to spend a bit of time, because that is becoming very interesting now, and many of the investors are not familiar with what is happening in the bond market. Bond market assumed serious significance after the Yes Bank issue. Yes Bank has issued all types of bonds. I would classify them into 3-4 types. There are bonds issued by banks. There is something called Tier 1 bond. That is what otherwise is known as the perpetual bonds. They are treated almost like capital from the Reserve Bank point of view to know capital adequacy norms. As you may know very well, banks advance money to the public, to the businesses, based on capital adequacy norms. There are very strict conditions imposed by the Reserve Bank of India on banks to make sure that banks don't fail. So when capital is not sufficient, the bank has to issue more capital. So Tier 1 bond, which is actually a loan document, is treated as equal to capital. So banks occasionally issue them, and in independent India's banking history, there has never been a problem with any type of bonds issued by the bank. First time, as I mentioned earlier, the Tier 1 bond issued by Yes Bank has been nullified. They collected more than 8,000 crores. That has been treated as nothing now. It is zero, but bond holders have approached the court, and indications are that they will get something back. Now, there are Tier 1 bonds issued by all types of banks. For example, in our own place, Trichy, South Indian Bank has been issuing Tier 1 bond. Recently, they issued in January 2020, Tier 1 bond, and the interest rate offered by them is 13. Very quickly, there was no time to issue the normal shares and all, but this market was very open. I talked to the managing director last week to know more about this thing. He said, because business was expanding, they needed capital. There was no time to go for the right issue or share issue. So they accessed the bond market. Within 15 minutes, the entire offer, they offered 500 crores or so, was subscribed by top marquee investors. That has been priced 13.75%. You can get it. If you want, you can also get it from the market. And normally the minimum for bank bonds is around 10 lakhs. That's a minimum lot for that. Now, that is Tier 1, which is called perpetual bonds. There is no maturity for that period. They keep on paying you interest but they have a call option, which means after a minimum of 5 years of the date of issue, if the bank wants, they can call it your the. This is what they do. When the market rate of interest goes down, they will call these bonds, but minimum 5 years they cannot. It should be in the hands of the investor. After 5 years, they have the option. So the market rate of interest goes down. Then there is tier 2 bond. It is called a semi-capital. It is not exactly like capital, but it is very close to that. So tier 2 capital interest rate offered by the banks, which issue them, it will be less than the perpetual bond, less than tier 1 bond. Tier 2 bond is said to be totally safe in the sense that even for Yes Bank, where the net worth was almost zero, Reserve Bank has decided and seen to it that entire tier 2 bond are protected 100% for capital as well as interest rate. Available in the market, and on your investment, you can get anything from 9.5 to 10%. That is the going rate of returns in tier 2 bonds. Tier 1 bond is not very popular now, the perpetual bonds, because of the black swan event that happened in Yes Bank. Not many people are comfortable with the tier 1 bond. But tier 2 bond be absolutely safe. You have got state bonds, Uttar Pradesh, Telangana government issue bonds, interest rate available to you, all the investors available in the secondary 9.5%. They can cover in guarantee. So I presume they should personally invested in tier 1 bond, tier 2 bonds and all, and have been getting interest rates regularly. I have not tried the state government bonds. You've got the corporate bonds, which give something like 7 to 10% return. A AAA rated corporate like HDFC Limited or LIC Housing Finance Limited, they all offer interest around 7.1, 7.2%. That is all what you get from such things. So the corporate bonds, depending upon the credit rating, AAA, you get around 7% return, AA or things like that, you get about 8.5%. You've got bonds issued by the NBFCs, the non-banking finance companies. We in Trichure have got dozens of NBFCs. All these are issuing various types of NCDs, non-convertible bonds. And the typical rate of interest available on them is 10, 11, 12%, depending upon the strength of the company, the quality of the board of directors, the capital base and all that. So anything between 10 to 12%. My advice to you, if you know the company well, which has a good track record, good quality directors on the board, and it has been with a large capital base, you know them very well, you can consider a reasonable investment because the returns are much, much higher. Because what you get from a bank, which I did not go into much detail, everyone knows, is around 5.5, 6.5%. That's all what you get after tax. Hardly you get about 4%. So everyone is looking forward to higher returns. So probably you can consider depending upon the type of people and background of these types of things. So that is about the bond market. I'd like to mention a few things about gold, because traditionally when we talk about gold, we talk about jewelry or gold coins. But these days you've got various options available. Many people are not aware. I'd like to take a couple of minutes into that. There are plenty of gold ETF, exchange traded funds available. Very simple, just like buying 100 Reliance or 50 Infosys, whatever it is. You can just ask your broker. You can ask them to buy an ETF issued by Nippon Mutual Fund or SBI Mutual Fund, any of these people. All these people issue that. Right from 1 gram onwards, you can buy 4,000, 4,500 rupees. You can invest. It will be part of your demat account. Very simple, very easy. You don't have to worry about somebody coming and stealing it away. Where to keep it? Nothing. It is all safe and secure in your demat account. You can, but the only point is in those ETFs and all, you don't get any returns. in the form of gold. It will keep track of the inflation. If inflation is there, gold always takes care. Traditionally, gold has taken care of inflation. But income return, nothing. But there also you have an option now in like sovereign gold bond issued by the Reserve Bank of India for the government of India. They issue it in different tranches, but you can buy it in the secondary market as well. They offer you 2.5% interest. The bonds are 8-year duration. After 5 years, you can encash them if you want. But if you keep it for the entire 8 years, you get this 2.5% interest. There is no capital gains tax, no tax, nothing. Very safe. It is gold as well as some return is available. Now, considering the developments in the world these days, every investment advisor is talking about putting part of the funds in gold. Do you know the return in gold in the last 1 year? Last 1 year exactly to date, if you take the last year, May, the return is 50% in the gold ETFs, 50%. Whereas in shares, it has gone down by anything between 5 to 20% in the last 1 year. You take the last 2 years, the gold ETFs have given you 22 to 23% return, whereas in share market, it has been -5 to -8%. You take last 3 years, gold has given 16, 17% average return, whereas share market, it has been sort of -2, 3 to +2, 3, depending upon the type of shares. I'm talking about the overall market cap type of situation. So now I quickly referred through the cash, the bonds, the gold, commercial real estate in metro cities. So the big game is in commercial real estate. Commercial real estate has been a very hot commodity since the RERA came into picture. The Real Estate Regulatory Act came into picture. The whole world, the Goldman Sachs and the Merrill Lynches of the world, they have taken very high interest in investing in Indian commercial real estate because returns are very, very high. I have personally invested in commercial real estate and I have found that the return is around 8-9% of the invested amount. Now, the residential real estate, you buy for living, no question of returns. But if you buy them and put it into the market on rental, the average return is between 2 to 3%. You can invest in through a paper, like a unit trust in commercial real estate. There are various agencies available in metro cities who would take 10 lakh, 20 lakh, 30 lakh, 50 lakh like that from you and make you a part of a very large investment in commercial real estate. So depending upon your ability, you can invest in them. You don't have to worry about rental, whom to rent, whether they will be there, nothing. They take care of everything. They charge you something, but they give you a return after that. Expectation of return in such paper-based commercial real estate investment is around 7-8%. That is readily available. For the first time, we have something called REIT, Real Estate Investment Trust in India, issued by Embassy, Embassy Office Park. They came out last March with a first share issue. It was a mega hit. That is what I was telling you a couple of minutes back. Paper-based investment in real estate. Just like you put it in a mutual fund, you can invest in real estate. The first such thing has come, Embassy Office Park, and issued it in March last year. And the returns today is almost 50%. That is the return in that. Don't expect that type of return. When I talk to some of these issuers on my trips to Bangalore and all that, where it is very popular, they say you can expect a return in such papers around 10, 11, 12%. How do you get that? What they say is part of it is rental, 7-8% is rental return, and then every year they increase the rent by 5%, or every 3 years by 15%. So if you keep it for 4 or 5 years and they keep selling their asset and buying new ones and things like that, all these things put together They are very confident of generating a double-digit return in the REIT scheme, Real Estate Investment Trust Scheme. 10-11% return, they feel very confident of offering to the investor. That's a new development. I want every investor to look at that seriously, because you may all have experience in investing in gold or normal land or shares where returns keep fluctuating. You would like to diversify your risk. This is one interesting option. Because in a country like India, real estate into the future is going to be a pretty big thing, because it's a very recent development. We had decent world-class office buildings only in the last 10, 12 years. And it's happening in a big way. And the world biggies, Blackstone, Goldman Sachs, and all have been investing billions of dollars into Indian commercial real estate. They would do it unless they see tremendous potential into the future. So now I'll come to my favorite area, that is stocks. In 5 minutes, I can't do much of stocks, but let me quickly give you a review and probably leave it to you to ask questions if you have any further interest. Share market is a very fluctuating market. Somebody who cannot wait for 3, 4, 5 years, who comes to the market with 2, 3 months perspective, I would say forget about it. If you're a trader, okay, that's fine. But trading, you have to do very carefully, not in a very casual manner, come to the counter and say, buy this, sell that, no. If you are a very serious trader, you can invest even for very short periods. But if you are an investor, you should have a reasonably long-term perspective if you really want to make money. Can you make money in stock market? Undoubtedly. That's the biggest wealth generator. If you take the history of last 30, 40 years, full details are available in India. The Sensex was designed in 1978-79 with 100 as the base. Today, even at the depressed level, it is 30,000. That is, in 79 to today is 41 years, it has gone up by 300 times. That's the typical Sensex item alone. If you talk about the returns from the normal shares and all, I got any number of statistics available. Infosys, if you had invested in 1993, the return is 7,500 times. If you had invested in Manappuram about 10, 12 years back, Manappuram is in our backyard, our own, the promoter is our own member. If you had invested in 2007, the return is 500 times, not percent, 500 times. A share like Kitex, where many of us invested about 10 years back, the return is 350 times in 6, 7, 8 years. 350 times. I mean, that list goes on and on. But fact is, it has been a very fluctuating item. If you don't have the strength, confidence, and willpower, you'll make lots of mistakes in shares. But if you have that, you come to the market with a reasonably long-term perspective, there is no wealth-creating asset which can be compared to the stock market. Some figures very quickly. In January this year, it went up to 42,274. I'm talking about the Bombay Sensex, 42,000. In March 24th, when COVID struck us badly, it crashed by 39%. Such a quick, swift crash we had never seen in our history. 39% in a matter of few days. From 42,000, it came down to 25,000 something. Again, from 25,000 in March end, it picked up 31% in the matter of another 2-3 weeks. It went up to 33,000 in the matter of couple of weeks. A pickup of 31% from the bottom. But now it is going up and down, fluctuating in the range of 30,000. I only want to tell you a few things before I leave it to you to ask any questions. In share market, don't paint the entire market with one brush. It is different buckets. You got large cap shares, which perform fairly steadily over a period of time. The top 100 companies in India are considered to be the large caps. The minimum of the large cap, as I was verifying today, is around 25,000 crore worth of assets. The largest company in India, Reliance Industries, is worth about 9,50,000 crores. The second largest is TCS, somewhere around 8 lakh crores. The smallest of the top 100 companies is 25,000 crores easy worth. Then you got what we call the mid-cap companies, 101 to 250. The first 100 companies called large cap. The next 150 companies, we generally call them as mid-caps. They have a market value of between 8,000 to 25,000. 8,000 is a minimum in mid-cap according to SEBI definition, and it goes up to 25,000 crores. About 150 companies is called mid-cap, and the others are called small cap. Small cap companies have a market value below 8,000 crores. I was verifying the list today. There are 4,000 small cap companies, and the smallest market value was 2 crores. I was just looking at it just to give you an indication. There is a listed company with only 2 crore market cap. Anyway, leave those things. Now, on investment in the stock market, I have a very clear view. If you are a very casual investor, you don't have the time or passion to do painstaking research, you want to be casual, the best thing is to go for a mutual fund. Either put a lump sum amount or you put in a regular monthly amount, what everyone knows as SIP. You can put in whatever amount or a lump amount, and they will take care. If you are going to invest it yourself, you prefer large cap companies because their fluctuations are relatively less, large or mid cap. But if you have passion to do research, follow up things very closely, and you have great interest, I can tell you some of us made money in the small caps. We did a lot of work on shares like Catholic Syrian Bank initially, Kitex Garments or Rofila, or some of this number of small companies, and Manappuram Finance, and all the returns have been astronomical, as I told you, some indications earlier. It is very simple. Stock market is definitely the largest wealth generator. If you don't have much of time or passion to spend on that, go for large caps, go for mutual funds. Much easier. If you want to have the fun yourself, buy mainly large caps and good mid-cap companies where you understand the company. You heard about the company, you deal with them, you know what they are doing, large caps to mid-caps. But if you are passionate enough, if you're willing to do the work, research, follow up, read the annual reports, understand, discuss with the management, participate in con calls and all those types of things, we can do large cap and mid cap as well, but small cap sometimes will give you much, much higher return. So a very quick review of the investment options. I was given 30 minutes. I think I've taken exactly 35 minutes. So this is a quick review of the various investment options available in India. Now I would leave it to you to ask whatever questions you feel are relevant. I'll try to answer to the best of my ability. Thank you very much.
Thank you, Anantharaman sir. It was an excellent session. We were hearing something like a story, such a difficult subject, investment. You made it very simple as you taking a class in the college.
Thank you. Thank you.
Many of our participants are your students previously set up as college now, right away. Anyway, it was an excellent session. Now we are moving to the question answer session. Either you can put the questions in chat box or you can raise the hand. Okay, here we have a question from Sriranj Visram. Sriranj.
Yes.
Sriranj, you can ask a question by unmuting your audio. Sriranj, please.
Hello, can you hear me?
Yes, yes.
Yeah, I can hear
Sriraj,
you
go
very well,
ahead.
Sriraj.
Yeah.
Hi, Sriraj.
Hello, sir.
Yeah.
I have seen that some countries are bringing down their repo rates, reverse repo rates to zero. But India, it is not happening. Quite so.
Yes, as I mentioned earlier, there are many countries which are in negative interest rate. The whole of Germany, Japan, Brussels, France, all these countries are having negative interest rates, and the United States 10-year bond rate is 0.6%. But in India, you can never think of that, at least in the foreseeable future, for the simple reason, in India, many people depend on income from interest for their entire livelihood. We don't have a social security system like developed countries where after you are 60 or 65, the state takes care of you, at least your basic requirements. Such a facility is not available in India at this moment. They are talking about it now, but at this moment it's not available. So senior people mainly depend upon their post office savings or PPF or things like that for their livelihood. So long as that type of dependence is there, a decent interest rate has to be provided for those people. There is a complaint that it is reducing now, it is going down, and they are very unhappy. Even at 6%, 7% they are getting, they are very unhappy. There's a long way to go before we reach the standards of Western world. So very definitely in India, we have to live with interest rate in single digit now. It was double digits earlier, but now it has gone down to single digits. Yeah, I don't see any change. Less than this, maybe another 0.5%, 1% maximum. But beyond that, I don't see the next foreseeable future.
So I have one more question. What would be the impact of printing notes on stock market? If the government is going to print the notes, how will it affect on stock market?
Yeah, as one of the main ways of relieving the pain caused by this Mahamari, one of the suggestions is that you have to put money into the pockets of the ordinary man, like what America is doing. America is sending checks, $3,000, $3,500. Checks are being put in every person's bank account. One fine money, you get a credit advice that government has credited you $3,500. This is what, as my daughters are there, they have been telling me this thing. So that type of thing, India government did not attempt. We put 500 rupees into 21 crore Jandan accounts because they were so desperately poor. Now, you asked about the economic aspect only. That answer is very simple. In printing notes and putting it into the hands of ordinary man without commensurate production will have the problem of inflation. But at a time like this, when there is acute demand destruction, due to loss of jobs and people going away from their place of work and all, the inflationary tendency possibility is relatively much less because that will go to actually boost the consumption and revive the economic activity. If it is continued without limits, it will have inflationary potential. But otherwise, immediately, I don't think that is a worry we have to think about. But government, I don't think is thinking seriously about putting money here because of the dangerous fiscal situation. I believe they could think of it to some extent, but somehow government is looking at other ways.
Thank you, sir.
Sriraj,
Yeah.
all your questions answered, I think.
Yeah.
One more question, I think, about the moratorium effect in banking sector.
The moratorium effect on banking sector, actually, there is no choice. Without any activity for the last 2 months and maybe for another month, partial activity, reduced activity, it is very difficult for borrowers who have no cash flow at all to repay the money. So unless a moratorium is given, it will be termed as NPA by auditors. They just go by 90 days interest payment norms. It will become NPA. So if that will kill the banking system, so moratorium is only a way of giving oxygen to the banking system as well as to the consumer, as well as to the borrower. No borrower would like to be termed as a non-performing asset, because that affects your credit rating and so many other things into your future. Nobody would like that. So the only option is moratorium. So while extending the moratorium like what the Reserve Bank governor did yesterday by another 3 months, the cash flow into the bank is likely to be affected, which will have some minor implications for that. But there's no choice. And I don't think there is any serious impact on the bank, because anyway, people are not going to pay. So I would say it's an oxygen to the system.
So it will be a problem for banking shares.
It can have a minor impact. I don't see a major impact, because it's a state of fact that people are not going to pay. The Reserve Bank will never give a moratorium if they can avoid it. They would have considered the repaying ability of the common borrower as well as MSME large borrower. They would have looked at that very seriously and realized that it is almost impossible for them to pay. That is the only reason why Reserve Bank gives moratorium. Otherwise, it's a very, very rare event. So the impact will be even without moratorium, the impact would have been worse. But now the impact, the cash flows will be affected, but balance sheets may not be affected.
Okay, thank you, Sriraj, for raising excellent questions. This has been solved queries of many of our participants. Now, our past president, Gunawardhan sir, raised his hand. I request Gunawardhan sir to put his questions. Sir, I ask questions, sir.
Hi, sir. Hello.
I did not raise my hands.
Yeah.
Anyway, it was an excellent disposition by Mr. Anantharaman. Congratulations. And thank you for enlightening the entire TMA community and others. Thank you.
Yeah, thank you, sir. Thank you. Thank you.
Now, Shantakumar sir, the past president, have some questions. Sir, you can unmute and ask questions, sir.
Hi, Shantakumar. Hello.
Hello, can you hear me now?
Shantakumar sir?
Yeah, I can hear you, Shantakumar. Yeah. Please go ahead.
Good evening, everyone, sir. You were saying that monetization of the debt. That when the government is in such a, deficit is very high. That they are in the lowest of the ranks in the sovereign investment grade. So monetization is out of question for India at present, I think.
I think reasonable amount may not affect the credit rating agency. They are also threatening the country, but a smaller amount, they put 500 rupees into the account of Jan Dhan accounts, 21 crore accounts. Nothing happened. And small bailouts may not, but a massive bailout like what they attempt in other developed countries, definitely a credit rating, it will go into junk. Next one is junk. So that is out of question. But some monetization depending upon migrant worker or other things, minor events. I strongly feel that looking at India's track record, credit rating may not be affected. If they profligate, if they go reach beyond levels, I'm sure it will have. But I don't think the present government will do such a thing.
Because the debt to equity as it stands, the debt to the GDP is already 70%. And I've read in newspapers that if this goes on, it will go up to 80%. So definitely we are likely to be ranked below we made a junk investment, sovereign investment.
But Shantakumar, please look at the debt to GDP of UK. It is 300%. Italy, it is 250% or so. So all these countries have debt to GDP far more than India. We have been actually generally a very conservative society with regard to debts. It's only the last 10, 20, 25 years maybe. I had never bought in my life or my father a house with debt. Because one, it was not available. Secondly, we are very debt averse. Neither be a lender nor be a borrower, that type of concept. So it is only the current generation or maybe last couple of decades that we have started going into debt. So relatively, our debt to GDP ratio compared to most of the countries in the world, it is much less. So there is some potential there, but they're unhappy about the fiscal deficit in this country, which is already into 2 digits, and it is going to touch maybe 12, 13% now. That is the big worry. The debt level, I think, is not a cause for massive worry at this stage. That's my take. Of course.
My last question is, Ruchir Sharma has said that the average return on equity investment in India, inflation adjusted, is less than 5%. So how do you say that equity in the long run is a good investment?
See, if you take the index from the time where that data is available, that is from 78, 79 on, the data is available, the return, compounded return on stock market is 15 to 16%. I reduced it by 1% because we always say 16 to 17%, but because of the fall now, I just tweaked it a bit. So 15% is the return on a stock market from the time data is available. That is higher than any other form of return. There's no question about it, no doubt about that. So the only thing is one makes mistakes. See, stock market is so fluctuating. If you are a consistent investor like an SIP, you get this 15-16% return over a period of time. Last 3 to 5 years have not been good for stock markets. That's the reality. Markets have not performed, even though indices have gone up and all that. Generally, the market has performed the last 2 years. So that is a reality. But wealth creation through stock market has been most phenomenal. If you invest carefully, forget about it, just put it in an index fund. Just blindly go into a Nifty fund. You don't have to do anything because those guys do a great job in managing the Nifty or Sensex. The weak ones are removed every 6 months and the big performers are added. So they keep managing the index in such a way that it reflects the new generation activities as well. And that return has been consistently on an average 15% for the last 30, 35, 40 years. That type of return on a consistent basis, the bank deposits give you 7-8% on an average. The gold also, the return is less than that. So double-digit return only from stock market over a period of time, not in a short period.
Okay, thank you, sir. It was very educative. Thank you.
Thank you, Shantakumar, sir. Now we have a question from Ragesh Mohan. It's an excellent question, sir. Are ETFs are safer than stocks? ETFs, exchange traded funds.
I would say ETF is an exchange traded fund. There is no question of safer than or anything. What is an ETF? ETF is actually a broad exposure to the entire stock markets. It's a broad exposure, depending upon whether you are putting in whatever index. If you are putting in Nifty, you are putting your money into the 50 shares. So the individual fluctuations. In India, you find frauds in various companies. Companies which you thought was very well managed, suddenly you realize that the person has run away and things like that. So if you put your money into one single share or 2 shares, fluctuation could be beyond your level of acceptance. Whereas if you put your money into a Nifty, you are putting your money into the 50 shares, whereby relatively the risk is much less. So it would be a correct statement to say it is safer. ETF is safer, but will you get more return in ETF compared to an individual investment, depending upon your selection ability and the time of investment and at which share you invest. ETF is definitely safer and easier, no question about it.
Okay, sir. Now moving to, we have plenty of questions. Mr. Balagopala, can you unmute yourself and ask question? Hello. No, I don't think he is not audible. I will ask his question. How about papers issued by NBFCs and guaranteed by the SPFCs recently announced? is about the papers issued by NBFCs and guaranteed by the SPV special.
The new scheme, I think he's talking about the very new scheme that is being implemented at this point of time.
Yeah.
Yes. So I mean, we are yet to see them, but it is a means of financing the NBFCs. The non-banking finance companies in India have been playing a very key role in keeping the wheels of industry and business moving smoothly, especially what we traditionally call the last mile connectivity. Because an ordinary man, even a small businessman in India, is even now a bit uncomfortable with the banking to go to a bank. I mean, I've been a banker. I'm not very happy to make that statement, but that's a reality that he says the bank wants so many documents, it takes time and all. Whereas you want to buy a two-wheeler, you go into one of these showrooms, Hero Honda or Bajaj showroom, just sign on the spot, the NBFC gives you money. So NBFCs play a very important role in the financial system in India. And since the failure of IL&FS about 3 years back, and the failure of Devan Housing and a few institutions of that type, credit flow to NBFCs have been very badly affected. They have been, I would say, choked. It's only a Manappuram or a Muthoot which can raise money in foreign markets. But an ordinary NBFC based in Trichy or Cochin, they have found it impossible to raise money. This problem especially became relevant after COVID. The Reserve Bank is aware of that, and the Reserve Bank has come up with this scheme of government guarantee. That means these NBFCs will issue bonds which will be purchased by the banks and with a guarantee from the government. I think that will help them in their functioning in a substantial.
Okay. Okay, sir. Then, we have a few more questions. Rima Kailash, a good session, sir. You suggested in mutual fund, we can invest in liquid fund or overnight fund. Is it a good idea to invest or shift a small amount to equity according to market? Please advise. This is question from Rima Kailash.
Yeah. See, shifting to equity, especially at this time, is very advisable. Very high quality shares are all on sale. Now, supermarkets are closed, malls are closed, but there's a sale, big sale going on in quality shares. A share which was quoting at 4,800, one of the finest shares like Bajaj Finance. It was at 4,800 rupees. That is available yesterday at 1,900 rupees. The India's finest share, HDFC Bank, it was quoting at 1,300. That is available at 830 rupees, more than 35% down. So it's one of the best times if we have money to invest in shares. Now, the first part of the question, whether it is time to invest in liquid funds, if you are an individual, there is no need to put your money into a liquid fund because you can get equal interest from a savings bank account from a good bank. As I told you, IDFC First Bank offers up to 7% on an SB account, savings bank account, whereas liquid funds is going to give you only 5 or 6%. Even Kotak Bank is offering up to 6% on savings bank. But for a business house, a savings bank account cannot be opened. They can open only current account, which gives no interest. So they have to go, a business house has to go to a liquid fund, whereas as an individual, you have the option to get almost equal returns from savings bank account, which has no restriction on withdrawal. So keep your money in savings bank account, a good savings bank account, which gives you high interest. Different banks offer different things. Choose. I give you a couple of names. Then how much money you can spare, put it into equity. But please remember, equity investment from a 3 to 5 year perspective. For a very short period, I am not advising anybody to invest in equity. If you want a higher return without risk, we can look at the bonds. As I told you, the bonds issued, tier 2 bonds issued by the banks or by the state governments, all these are available around 9-10% returns are available. But if you want a much higher return, you're willing to take a bit of risk, nothing like equity shares. That too now, when I call it, the shares are available on sale.
Thank you, sir. One more person raise a hand. Name is not visible.
Anju.
Anju, is it Anju? Unmute and ask question, please. Hello. I think sound is not audible. Hello. Yes, yes. Please ask a question. Hello. Anju, please ask question, please. I think some problem with the sound system from that end. We are about to touch our targeted time. So before winding up, a quick question, sir. With respect to the gold, according to you, whether gold price will further go up or come down, depending on this present scenario?
I was expecting that question. It's a very timely question, I would say, because gold price is almost at all-time record in rupee terms. Gold had cost $1,920 per ounce about 10, 12 years back. Now it's only around 1,700 something, 1,700 something. Dollar terms, it's not yet 10% below the all-time high, but in rupee terms, it is I think at all-time high. Now, question about the future. Of course, disclaimer, future nobody knows, but what do I expect? There is a very good possibility that gold from 1,700 now can cross the previous peak of 1,900, cross 2,000, cross 2,500 in the next couple of years. There's a very good possibility of gold crossing $2,000, $2,500. I'll give you, there are any number of reasons. I will give you one key reason. If it happens, only God can help us. That reason is this. China is holding more than $3 trillion worth of foreign reserves. It is mainly in American bonds, American government bonds. China and America have started a big fight. We thought it will settle, but now it is escalating beyond settlement, I think. America has removed 700 Chinese companies from American stock exchanges yesterday. If that news is true, that news is really true, but there may be some more procedures. I do not know about the exact time of removal. If such things happen, the fight escalates. If the fight escalates, China might convert American securities into gold. If any such move happens, gold will cross $3,000 an ounce. So my answer to the question in simple terms, I think although it is at all-time high, we can wait for a few days to see its movements. If it comes down, it will be a better time to buy. When you buy at all-time high, you always run a risk, but potential for gold into the future, very good.
Thank you, sir. It was an excellent session. We have really enriched and enlightened about the various investment opportunities. Before going to the formal vote of thanks, we have an announcement. 26th, the next Tuesday, we have one more webinar. It is by Managing Director of CSB Bank Limited, Mr. C.V.R. Rajendran. He will leading the session, Banking in COVID times. At this point of time, many of our members having doubts regarding the banking sector, about the moratorium and all. So we have arranging a session on 26th. Topic, Banking in COVID times by Mrs. C.V.R. Rajendran, Managing Director, CSB Bank Limited. Over to Sijo.
Thank you, Sony. I think, hello.
Yes.
Yeah, I'm audible. Okay. Thank you, Sony. Excellent work again. I have to appreciate the president for putting an additional effort to get the right topics into for the webinars. And very pleasingly, we almost reached 100. We reached about 96 members participating today. We wanted to reach 100.
That's great. That's really happy.
Sony actually wanted to hit a century, but I think he missed it by a few runs. Anyway, it's a good section also, and very interestingly, so when during the COVID time, we were always worried how to recover our funds. That is one, as a businessman, that is one thing which we had in our mind. Apart from that, to invest continuously. Now you have given everybody an option other than thinking just on shares. You have worked, you have lectured on all the other alternatives also, which is eye-opening for every member over here. The bonds, the gold, the whatever it is. You have given us a list of alternatives with your vast experience. I think the section went very well. We'd like to thank you for the excellent section, and we'd like to thank you for sparing so much of time for us as a TMA member. All the members like to thank you, and I like to thank all the participants and the past presidents and the technical team who's behind this for this particular webinar. Thank you. Good day. Back to you, Sony. Thank you.